I don't know if our stock is cheap or not, but we have way too much cash and we don't know what to do with it. We're just returning it to the shareholders. And Apple's, especially Google's shareholders, complain quite a bit. Let me show you how much cash and cash-like stuff Google has. I'm going to look at the quick and dirty number from Yahoo Finance. Financials. Quarterly. Balance sheet. Okay. As of the end of last year, they had $24 billion in cash and cash equivalents, $87 billion in other short-term investments. Those things are typically Beatles and stuff. So effectively speaking, Google has $110 billion in cash. As long as there is something they can do with cash that earns better than just interest rates, that may not be a bad idea. Typically, companies like these, they say, I'm going to keep the cash. If I see an acquisition opportunity, I'm going to go ahead and grab it. And cash acquisitions typically create a bump for the acquirer. Stock acquisitions create a decline for the acquirer. Because you have a chance to pay cash, but you say, I'm going to pay you in Google stocks. That means I'm going to issue new shares. A, you're diluting your existing shareholders. And B, you're basically saying, I have cash, but I'm not using cash. That means I don't think this stock that I'm paying with is worth as much as what it is in the market. So that's viewed as a negative signal. Minus, we're going to call this net new equity. Remember, you may not force you cannot force your shareholders to pay you dividends. So dividends cannot be negative, but repurchases can be negative. I know that doesn't make sense, but there could be negative new, there could be positive new equity, which means you issue new shares and your shareholders pay you. Right? In that case, net new equity is positive, so that reduces the cash flow to creditors. Whenever a cash flow to somebody is negative, that means you're getting cash from that somebody. Remember, negative cash to is positive cash from. And cash flow to creditors, how many different ways to leave your level? 51, right? No, 50. You guys may be too young for that song. Who knows that song? It's one of the most beautiful songs. It's a Paul Simon song. It's from the album he tried all the African melodies. One of them says, "Seek the Lord." All right? How can you give money to your creditors? Huh? You already owe them money. So if I borrow from my creditors, do I pay them? If I do, bring those people to me. No. If you repay them, or if you pay interest on existing loans. For accounting purposes, interest on a loan is not considered a liability. It's considered an expense. So the credit item goes to income statement. But if you pay an existing loan, that reduces the liabilities. Just like the same idea, Interest is basically dividend you pay to the creditors, if you think about it. Interest minus net new borrowing. If you paid off $100 million of the existing loans, but you also issued another bond and collected $200 million, that is $100 million of net borrowing. Okay, that part was easy, not too painful. Now we're going to think about where does the cash come from? And sources of free cash flow. AKA CFFA. That's equal to, first one is OCF, short for operating cash flow. How much cash is generated from your operations? Again, when we say cash, we're not talking about the greenbacks. Minus change in net working capital. You can think of change in net working capital as investment into working capital. If you increase your inventory by $50 million, you basically invested $50 million into inventory, right? And if you didn't do anything to your current liabilities, that means you financed it yourself. Or $50 million higher accounts receivable. Technically speaking, you didn't spend the money, but you didn't get any money either. So you have to finance the cost of that. And minus NCS, short for net capital spending. Let's talk about OCF first. Operating cash flow. There are two different ways you can do it. You could start with EBIT, earnings before interest and taxes, and you add back the depreciation tax shield and stuff. I like the direct way. Take the net income. Add back the depreciation and interest expense. First of all, depreciation is not even a cash expense. Technically speaking, it is an operating expense. For income statement purposes, the economic reasoning behind it is that's how much wear and tear there is. If you were to sell this asset now, you would have taken a haircut on it, and that's the depreciation. But that doesn't always work that way. In any case, it is not a cash expense you incur. It is an accounting expense. Back when I taught MBA finance, and thank God I don't even do it anymore. And I'm not even Christian. By the way, this is Catholic. If you didn't know. I may not be Christian or religious, but I do know a lot about religions. Just to make him be able to argue in favor of stuff, they don't necessarily agree. I used to give him a weekly statement, and randomly you either got assigned for or against. And the first question always was, depreciation, what is it good for? Come on, you don't get the reference? Anyone? Am I that old? It's a Jimi Hendrix song from 1960. War, what is it good for? Absolutely nothing. Anybody fan of Jimi Hendrix. Only the best guitar player ever existed. Not the classical guitar, the rock guitar. We also add back interest expense, even though it is a cash expense, that is not an operating expense. You don't incur that cost because of your normal activities of the firm. That is a financing charge. And you know how to calculate net income anyway. Change in Newark and WC is basically change in current assets minus change in current liabilities.